Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today again is Chris Vermeulen from the Technical Traders.com. How are you today, Chris?
Hey, I'm good, Tom. Thanks for having me.
Great to have you back. So I wanted to talk about, obviously we've seen silver just go crazy this week, and why does the recent massive upside in price in silver cause technical traders to possibly begin to sweat?
Well, silver obviously has started a new bull market. This week, it broke through more or less a $21 resistance area, and from there on, the following session, the market jumped another, 8% the next day, with people starting to sweat. So anyone who is short silver is now really getting a short squeeze. They're squeezed to get out of their trade, and that creates this buying, this feeding frenzy, this parabolic move that we've seen. And of course, something that's been in a bear market for many years means there's a lot of people short. And, that's why we're getting this big change in direction. And so when people have to cover their shorts, and people are in a major panic right now doing that, they not only have to, generally they buy back their positions, which is what causes a wave of buying, but then they know it's in a new bull market. And so they also want to buy some to own long. So it creates this double buying pressure on top of the excitement already. And so, there's been there's some huge short positions. Somebody sent me a tweet just the other day, yesterday, saying it was going to take like over 130 days, trading days, for all the shorts to cover their position based on the volume levels in silver. So, I don't think they're going to just cover straight and it's going to go straight up like that. But it just goes to show how big of a short position there is in the silver futures market. So it's massive. And that's all those people right now are sweating bullets, hoping that it's going to pull back and they can, start covering at a lower price.
Wow, that's a massive short position to be able to have to kind of clear out. One of the points on that recent silver article was an upside move of 540, a measured move level, and price attempt to move dramatically higher. So could you tell us a little bit about how those technicals really speak to the chart and what they mean?
Yeah, well, when you look at the daily chart, we get some short-term Fibonacci measured move targets, and we hit one already. So the $21 level was not only resistance from 2016, but it was also a Fibonacci measured move from the March low that we just had to the recent rally and pause. And so I was showing subscribers saying, hey, this 21 level is very significant. It is a major Fibonacci measured resistance level based on the most current huge price swing in silver from the March lows to now. If it gets to 21, there's going to be some selling. It's resistance. And then when you go back on the chart to 2016, you see it was a major significant high on the monthly chart as well. So that is a really key resistance area. So it was very significant. And I told everyone, if it breaks that level, then we're going to probably see this market just break out and there's going to be a big move and a run to the upside. And that's what happened. Market closed above it. And then the futures, when they reset later that same day, they just instantly skyrocketed with everyone seeing that confirmed bull market piled in silver rocketed higher. So that was the first measured move they got hit and broken. So now we're in a bull market. The next upside target I have is about the 24.30 area for silver. Right now it's at $23 an ounce. I think we've got some pretty big resistance all the way up to about 26.30, which is the 2011 and the 2012 lows. It's going to act as a very significant resistance zone. And if we were to look at what potentially could happen going forward, say gold miners and metals continue to outperform the stock market, which is what they're doing now. This is the type of market condition that they thrive in, which is generally right near the end of a bull market for stocks. Stocks become choppy. They become very selective, meaning there's always going to be hot sectors and cold sectors. That's the sign that we're usually getting close to a bear market for equities, because money's just getting very picky to where it wants to go. And this is when the miners shine. And we actually saw this back in 2007, 2008. We saw gold and silver and miners rocket higher during those last 3 months before the bear market started. And I think we're in that exact same phase right now. They're taking off. They're starting to run. I think silver is going to run up towards that 24 to 26 range. Those are the next key targets. And then I think the stock market could roll over. And then I think it's actually going to start to pull metals and miners back down, which is perfectly fine. We've seen this happen many times before. If the stock market goes into a bear market, miners, gold, silver get pulled back. And really, if we were to see a 6 or 8 month correction and sideways move in this sector, it would actually build a stronger base for a bigger move later. So I think there's more upside in metals short term for only a month or 3 tops. Then I think they're going to be under pressure during the bear market. And then we see this sector come to life a few months before the bear market ends. And that's, to me, is when the big opportunity is going to happen, because the market will be cleansed. There'll be more fiscal stimulus. Everyone will have been finally shaken out of these markets, forced liquidation, margin calls, and the charts will all have these beautiful consolidations. And that's when I think we see silver go, 48, 100. Who knows how high it'll go. Gold, mid 2000s, 3000 range. So I don't think we're at that explosive move yet, but I think we're getting darn close, a year or so away out from something very significant.
So do you have kind of a timeline idea for some of those higher targets?
Yeah, okay. So, I think we could see silver run up to this 24, 26 area over the next couple of weeks. I think it's got that potential to do that quickly. I feel like the equities market is super close to rolling over. I think we're only a month or 3 away from the stock market putting in a major double top like on the SP 500 and actually starting to roll over and move lower. So we're really close. We're in that final stage where bonds and the leading sector like tech and precious metals are kind of the favored and moving higher. And they're going to move up while the market here, I think the stock market trades sideways or slightly lower. By the end of this year, I think we're definitely in a bear market. We got elections coming. We got COVID coming. It's all these things are coming. The big wild card is the stimulus, right? The Fed keeps just dumping in $1 trillion or $3 trillion. Obviously, that is going to help prop markets up. But they did stimulus back in 2000 with the tech bubble. They did stimulus in 2008, which had to be a lot bigger to support the market. And now we've got it again. And once you start pushing money in every time, it has to be bigger and bigger to continue to keep the momentum. And I can't. Who knows what the Fed will do? But you can only throw in so much money. And when the selling actually does start, I don't think the Fed can actually stop the stock market from falling. If the sentiment changes enough that everyone is actually in sell mode, they can't hold and prop up the stock market on their own. But they're doing a darn good job right now. But the economy hasn't really turned bad yet. It's completely masked with the tech holding the stock market up. The reality is, if you go and you look at the individuals and the small businesses are dropping off, closing their doors. People are, if they stop giving unemployment money out, that's going to be the last straw where people who don't have jobs and don't have any savings are screwed. And that's when the economy really goes. The U.S. economy, even the Canadian economy, is powered by small businesses, and they're the ones suffering. But you don't see that in the stock market, because the stock market is driven by big tech companies. They're all offshore. The U.S. gets really no benefit from them, but they make everything look super peachy. This market's amazing. We're hitting new highs in the NASDAQ, but it really means nothing for U.S. They don't get any taxes from these big companies. It's nothing. It's the small guys that are going under silently and are in pain, and the defaults for loans and mortgages are spiking. And it's just the tip of the iceberg for what's coming. The average Joe is going to be suffering substantially, and the defaults are going to be insane. But that, I don't think, is going to come in for another 3 to 6 months. And that's when the stock market is going to be under serious pressure.
So obviously, Chris, we're seeing much more volume come into the precious metal space. What kind of weighting do you give that, and how does that enter into your looking at the market?
Yeah, so I give a weighting of like 10 or 15% for like a portfolio. It is, you don't want to be overexposed. everyone, I mean, a lot of precious metals traders are crazy high risk. They'll have like 80 or 100% of their account in metals and miners. But I mean, as an average investor or trader, you don't want overexposed in any specific individual sector. And this sector is so volatile that if you had 10 or 15% of your long-term investing portfolio, I mean, that's more than enough to have a substantial gains when this sector does take off. So, I mean, I'm not heavily weighted in it. I own a lot of more physical than individual stocks, owning shares, just because I don't fully trust the financial system. I'd rather see physical metals stored in a vault outside the financial system versus equities. But I mean, the equities here, this precious metals market is broken into a bull market. You have to own some for long-term positions at this point because they could continue to run. At a short-term basis, I mean, they've had a nice pop. They're getting up into an overbought territory. The stock market is about to roll over. I think we're going to see them come under some pressure here over the next week or two. But overall, I mean, the sector is still primed and ready. You have to have some weighting somewhere in your investments, whether it's long-term or short-term. You should be involved with them.
Absolutely. So let's contrast that a little bit of a rosier picture for the precious metals and contrast it with obviously, we're looking at somewhat of a fiscal cliff in the U.S. There's a lot of things that are coming due that are negative for the market. So let's talk a little bit about the dollar. There's a possible breakdown to the downside currently. And one of your articles was suggesting that it's 7 to 9% above major resistance. Yeah,
so the dollar obviously printing trillions is not good for a currency, and the dollar is starting to go into free fall mode, and it started to break I think it was the March low there in the US dollar index. It's breaking that this week, which is not a good sign. That's the sign that the US dollar looks to be starting a new major downtrend. I mean, it's been in rally mode since 2018. And that tide seems to have turned. And of course, a falling dollar is good for metals. So there is quite a bit of downside. I mean, right now, the US dollar index is at 94.60. I think it's got potential to go down to around 93, a kind of 40 area. So there's still some more room, but it is picking up speed and it's dropping into the support level very quickly, which means we're most likely going to see the dollar have a big bounce here soon. Last time it got to this level, it went from this level all the way up. So it went from 94 all the way to 104. And it did that in 2 weeks. So there's a potential here that the stock market starts to roll over and people force liquidate. They move to cash, which means they're going to start buying the US dollar back. And we typically see the US dollar rally when there's fear in the market. People cash out of their investments or they're forced out of them from margin calls, and they move to the currency that is the strongest or that they believe in the most, which always tends to be the US dollar during a global kind of crisis. So I think the dollar is getting close to a bounce, but it is in a downtrend, and I think it's got some more room to fall. I think it's got another penny to drop from 94.60 to 93.60, 93.40 area. And that's going to help, continue to get metals higher. But there's going to be a time here when stocks start to sell off, the dollar starts to bounce, and all these things are going to pull and weigh down on the metals and the miners.
That was actually part of my next question here. If when we see this, let's say, general equity drop, if we're going to see gold and silver get pulled down with that, possibly to cover some of the margins. So let's contrast the metals with the miners. And do you think that everything will get pulled down together?
I do. I mean, there's different types of selling in the market, and they happen at different times in the market. So generally, like right now, we're still seeing a very high correlation to what gold miners are doing to the SP 500. Now, yesterday, the SP 500 was down 1.5% at one point in the day, and it was high volume selling. So it was distribution selling, broad market. So there was a big wave of people just selling their positions. And every time we see that, gold miners actually get hit really hard. So SP 500 was down 1.5%. GDXJ was down 4.25%. I mean, it's running at like a 2 or 3 times beta of the stock market. And that's what happened in February. Stock market fell 35%, gold miners fell 57%. I mean, they drop a lot faster than the stock market, and they're still showing signs of that right now. The thing is, as soon as that heavy volume selling lets off during the intraday session, we see miners get bought back up and they float right back up. So they're seen as a safe haven, but they're not immune to any high volume selling. So what I think is going to happen is, as the stock market starts to roll over and sell off, we're going to see miners sell down with them. And then there's going to be that wave of fear that more or less creates margin calls. We're going to see price sell off more. It's going to create margin calls. And then there's going to be a cleansing in the price, and they're going to sell off. And eventually we're going to see them probably find support and actually probably stop really going down, because this time around is different than 2008. I think the problems are bigger now. I think there's more fiscal stimulus, not just in the States, but I mean in every country is pushing money into the market. And so this whole scenario, as the economy gets worse, the Fed is going to do more, which is bullish for metals. So I think they're going to be somewhat supported this time around. I don't think they're going to fully crash. And the March sell-off, I think, cleansed a lot of leverage out of the market. So I do think they're going to sell down. I don't think they're going to collapse. I think they're going to pull back 15, 20, 25%. But then I think they might be very supported for a long time until the big selling pressure of a potential bear market eases off. And then these things are just going to, float up and just keep running higher and higher. So I think they're going to do okay, but they will be under pressure during any sell-off we get with the stock market.
Excellent. Let's talk a little bit about the put to call ratio on the S&P and what that's kind of showing us.
Right. So if you look at the put call ratio, the total put call ratio, it's hitting some interesting levels. So back in 2016, it reached a certain level where everyone was buying call options. There was like no put options. So everyone's expecting higher prices and they're buying lots of leverage. They think sky's the limit. Let's just keep buying these tech stocks just like they are right now. I mean, they're piling in. And when there's this little amount of fear in the market and everyone is buying leverage to the upside with options, that's usually when the market is getting exhausted. It's on the verge of rolling over. The same level was hit last time in 2016, and then we went into a sideways trading market for a year. And the market had some pretty big corrections. I don't remember what they were, but I'm pretty sure they were 20+% corrections each time. And it was a very tough, choppy market to trade or to even hold investments through. And so we're getting down to this level again. We actually almost touched this level in February. We're pretty much there, only a couple ticks away. And we know what happened in February. The markets crashed and we saw another sell-off. So we're back down to those levels, lower than we were in February, lower than we were in 2016. So there is zero fear in this market. Everyone's buying. And that's a sign that this market is starting to run out of steam, because if everyone's already bought all their stocks, now they're buying leveraged options on top of it. I mean, they are 100% sold on the theory that this market is just starting a new bull market. And typically everyone gets caught holding the bag at the top when they feel like there's nothing to lose. Like they think the Fed's going to support them, which the Fed's going to try. But I don't think the Fed can support the whole world economy, the stock market, when it starts to sell. And there's other things at play. You look at the volatility index. The volatility index is back down at the February lows. So we're back at the same fear level we saw just before the stock market started to crash. So there isn't fear in the volatility market. And you look at the amount of stocks trading above the 200-day moving average. That is giving us bearish divergence. We have the exact same setup between the amount of stocks supporting this rally and what bonds are doing. That same setup that happened in February is happening right now. And I have a chart of it that shows us very clearly that this stock market is running up with fewer stocks supporting it. And bonds are showing the exact same pattern they showed last time. So all these things lining up. The market internals are weak. People are bullish. They're buying lots of leverage. We're seeing bonds and precious metals and utilities start to outperform. That means big money is actually moving into those defensive plays, and they're unloading shares of regular stocks. So I think there's a big downside move coming, and it's going to catch everyone off guard because everyone is buying like there's no tomorrow, and they think it's going up and up and up. And I mean, it has been going up and up. You can't argue there, but we're finally back at a level here that is insanely overbought, and the technicals and the fundamentals aren't supporting this at all. So when those things align, I mean, prepare for a double dip or worse.
So in one of your other articles, Chris, it highlights the double top in the S&P or the E-mini S&P and the transportation index moves. Are these signaling exactly what you were just talking about?
Yeah, more or less. So the transportation index typically leads the market because more or less transportation is one of the first industries to kind of get hit. If things slow down, the transportation market, those companies start to underperform. And because that means, your stores didn't sell as much this month, so you don't have an order in, it's not getting shipped. They're kind of the first front line to really say, hey, there's not as much product being shipped anymore, which means there hasn't been as much selling. And so when the transportation market's underperforming, which it has been for quite a while, actually, if you look at the IYT monthly chart of the transportation ETF sector, I mean, it's actually starting what could be potentially a huge head and shoulders formation starting from 2014. And it's underperforming dramatically. It's back up to a resistance area. And the SP 500 is coming back up to a potential major double top. And I use the SP 500 to gauge the broad market. I know the NASDAQ has been making new highs, but that's because it's, very tech heavy. And this environment favors technology and online services. So that whole NASDAQ is on fire. But the reality is the SP 500 is coming up to a double top. The Dow's been underperforming, not really near it. The Russell 2000, multi-year away from, it's underperforming like the transportation. And those are all signs that, okay, this is a sector-driven, very specific market rally. And when precious metals start to outperform, when the market becomes unstable like this, it is a huge red flag that there's stress in the system and people are getting defensive. There's concerns. And that's why gold keeps moving up, is because it was the first to start a bull market, is because globally everyone is concerned. This is not US based. This is the whole globe. People around the world have been buying gold. It's the number one commodity on your brain. For an investor who doesn't follow precious metals, they know there's stocks, there's bonds, and then they always hear about gold. And so that's why gold has been outperforming, is because the average Joe is concerned and they slowly buy their little bit of gold that their advisor says and into those gold stocks. So that's why that sector's been doing well. But overall, the health of this market, slowly deteriorates. But bull and bear markets don't top in, a day or a week or months. It takes, usually quarters for a top in the stock market. And I feel like we're a quarter or two into it. We still may have another few more months, but I do feel like this is going to be rolling over and things will be much lower later this year.
Excellent. Let's turn a little bit to oil. Is there a possible move to the upside, considering the supply shortages that we've had since we saw the price dip below zero? Or what are the technicals suggesting versus the fundamentals?
Right. Well, the trend of oil is up. It looks and feels like it's on the verge of a big drop. It has gone up. It's filled a gap fill from February where crude closed it one day at one price, and then the next day it opened substantially lower. So prices come all the way up, and it's filled that gap. And it pretty much nailed it, to the tick. And then we've seen it stuck under that level and with some selling. So overall, what I'm looking for crude, I think there's potential for $44, maybe $45 a barrel for crude to the upside. But at this point, what I want to see is a further pop here, which would be, I think, a short squeeze because we're stuck under this gap window. We're stuck right at that resistance level. And so if it pops, it's going to create anyone who is short to cover. And then I think it's going to get crushed and stepped on and sell off. And when it starts that big reversal, that sell-off, I think crude's got a lot more downside potential than it does upside. So I'm waiting for like a pop and then a drop And that to me will be the signal to buy an inverse ETF on oil, because I think oil could very easily drop back down to 28, potentially even back down to 20 or 24 range. So there's a lot of downside there. And of course, if the economy does get soft, which it is, I was actually on CNA radio last week, and I talked about how the initial jobless claims, the trajectory of how they've been coming. I was saying this week is going to be a big week because we could actually see initial jobless claims start to rise. And boom, this week they actually started to rise. So there's more jobs being lost now. So this is just starting to kind of rear its ugly head that, okay, there's another wave coming. People are starting to get laid off again. And that to me is when the economy starts to shut down and people are losing jobs. I mean, that means crude oil is likely going to fall. Demand will continue to kind of collapse. So
one of the last things I'd like to touch on, obviously related to more jobless claims and less people actually going to work, is real estate. Let's talk a little bit about one of the first real estate sectors that's going to get hit, commercial real estate, and why some of the reasons are that that's obviously going to get hit pretty hard.
Yeah, it's pretty obvious. Everyone is now starting to work from home. And obviously, you don't need a business commercial front if you're working from home, or if you do have a commercial front, all these people are downsizing. We don't need, a 10 office space office. We only need 4 of us in here now, and the other people are either let go or they're working from home. So everyone is downsizing their commercial space. If commercial space is now dropped, it's going to be almost free to rent soon. I mean, give it another 6-8 months. It's going to be a dime a dozen. Pick your office space. Everyone's starting to work from home, and that's been the big shift. And that's why we've seen technology do so well, as everyone's realized, hey, I need to now buy my own computer. I need to buy the webcam. I need to buy online services for quality Zoom calls and whatever you're going to use. Everyone's been loading up with all that stuff, not because their business is booming and the economy is good. It's because they want to work from home, they're forced to work from home, and they need this bloody equipment. So this huge wave in buying is really forced buying. It doesn't mean the economy is good. It means we're going through a change in how people run businesses, how people are living. And because of this change, people have to tool up their home offices, their spare bedrooms to work from home. So that's the big thing. And the other thing is, now that people are working from home and they can't travel, I think we're seeing a lot of that travel money where people are going to go on holidays. They're like, hey, it's going to be a staycation now. We're going to stay home. So now people are buying all their toys. I mean, people are going on shopping sprees, buying stuff for their cars, you name it. So there's this big push in buying that the media keeps saying, hey, business is booming. Retail sales are bouncing back. Technology sales are skyrocketing. I mean, the media says everything's peachy, but technology is all forced buying. People are feeling like they need some outlet, and they haven't been able to buy for a few months. So they're catching up on their buying, and they've taken their travel money and they're using it to spoil themselves so they can enjoy their home or their cottage more because they can't go anywhere else. So everything to me is this huge fake front of what's going on under the surface. And big trends like this take a long time to play out. Even though we saw it months ago, I mean, it still could take several months for this ugliness to really kind of start to percolate, through the markets, for everyone to see and smell the roses and be like, holy crap, this is pretty bad. So that's kind of where we're at, right? Just letting people slowly load up on stocks while really the underlying are eroding very quickly.
Excellent, Chris. Well, I think we touched on pretty much everything. Do you have anything else that you should mention?
No, I think that's about it. I mean, just be really cautious here. The SP 500 is about to fill its last gap on the chart, which was from when the start of the crash started in late February. So we are about 2.5 to 3.5% away from a gap fill. And if that gap and when that gap gets filled, any reversal on the stock market after that to the downside could be the start of something really big. But just knowing that almost every gap on the SP 500 always gets filled. Once that gets filled, I mean, it could be lights out. So be really aware. We're only a few percentage away from a double top and a gap fill that could signal a huge reversal.
Perfect. Advise caution going forward. Thanks for your time today, Chris. Really appreciate it.
Yeah, thanks, Tom. Always a pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?